Hello, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of What's Next for Real Estate, highlights from the Mortgage Bankers Association Annual Convention. Thank you for joining us. My name is John Bicheski, CRE, and I'm the sitting second vice chair of the Counselors of Real Estate and the president and founder of Real Estate Fiduciary Services in Somerville, South Carolina. The Councils of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset types. Each has earned the prestigious CRE designation. Let me recognize our exclusive sponsor for today's webinar, Equus Capital Partners. Thank you for your support. Attendees are encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. I'd like to introduce today's moderator, David Levy, CRE, a real estate consultant with a storied career in our industry. David is known for his work in portfolio management, research and strategy, most recently with Bentall Green Oak. He was invited to counselor membership in 2014. Welcome, David.
Thank you, John. And good afternoon, morning, and evening, everyone. Thanks for joining today's webinar. As John said, I'm David Levy. I'm vice chair of the virtual program sponsored by the Counselors of Real Estate. And I'm based in the Boston area, member of the New England chapter of the CREs. Today's CRE What's Next will share highlights from last week's MBA conference with a focus on the current and future state of the U.S. commercial real estate debt markets. And if time permits, we'll touch on other select hot topics that were covered at the convention, such as AI, property insurance, or affordable housing and their impacts on the real estate industry. Registration for today's program totals around 300 in number, and it's primarily North American based, but with representation from across the globe. So again, I thank you for joining us. You are all too aware that given where U.S. interest rates are today relative to even just 20 months ago, the yield curve still remains inverted. The availability of traditional commercial real estate mortgage capital is reduced and more expensive. Commercial real estate transaction activity is relatively low. Bid-ask spreads are wide. Values are down. And the consensus view is that rates may remain higher for longer. And as a result, the markets are performing generally uncertain and volatile. And so reflections and commentary from sources like the Wall Street Journal, CNBC, Bloomberg on the U.S. commercial real estate market has become like an everyday event, including multiple stories earlier today. So as a result, we thought the timing of today's session would be ideal, especially following the Mortgage Bankers Association annual convention in San Diego. So I'm joined today by three well-known industry experts, all of whom participated on panels during last week's MBA convention, and who are also frequently quoted in the press for their views on the U.S. commercial real estate debt markets. All three deliver with substance. They can be opinionated, often animated, and I expect we'll hear some insightful anecdotes, reflections, and useful key takeaways. I anticipate the format will be mostly conversational. So as John said, please feel free to post questions using the Q&A feature on your screen at any time. And we'll attempt to have those answered as the program unfolds. So now let's meet the three panelists. Victor, you want to kick it off and introduce yourself? You're on mute.
Yeah, I know. I figured we should start all webinars with that, right? Thanks for having me here, David, allowing me to participate in this conversation. Victor Kalinaw, Global Head of Research and Strategy for Manulife Investment Management, Real Estate, Private Markets. Back to you.
Lonnie.
Thanks, David. I appreciate the opportunity to be on the panel discussion today. Lonnie Hendry, Chief Product Officer at TREP, data modeling and analytics firm, also co-host of the TrepWire podcast, which is at about 1.2 million listens. If you haven't checked us out, we'd love to have you as a listener on Thursdays.
Nice. And finally, Jamie.
Thanks, David. So I'm Jamie Woodwell. I'm the head of commercial real estate research at the Mortgage Bankers Association.
So maybe I'll stay with you, Jamie. We hear about this wall of CRA mortgage maturities coming due, and there's a multitude of forecasts offered by lots of different resources. Can you help set the record straight and provide us some context as to what we're going to be facing this year and maybe into the next couple?
Yeah, sure. And I guess we've got a couple of pictures to show that. It was a hot topic and part of a lot of the conversations at MBA's CREF convention, talking through the maturities. We actually released the results of a survey that we conduct at the end of each year, going directly out to servicers and asking them how much they have in upcoming loan maturities. So we're able to dig pretty deeply into it. Shay, I don't know if we've got those slides. Fantastic. Just to set the context too for some of those numbers, one thing that comes up a fair amount of time is just sort of what is commercial real estate. And so, part of what the maturity numbers and others have helped us do is really dig into that. And the fact that if you're looking at income producing properties, so the properties that we all know and love, those that have leases that derive income from rents, et cetera, there's about $4.7 trillion of commercial and multifamily mortgage debt outstanding on those. We think of that as sort of one industry, but what's really interesting is that it's spread out over a whole variety of different capital sources, property types, vintages, as we'll get into in the maturities and other things. So just breaking that $4.7 trillion of commercial and multifamily mortgage debt outstanding down, there's about $2 trillion of that on apartments, about $730 billion of that on office. You can see sort of the other breakouts by property type on the left, and then on the right-hand side by capital source. So about 1.8 trillion of that 4.7 trillion is on banks' balance sheets. You have just a little less than $1 trillion held between the GSEs and FHA. You can see CMBS, life companies, and others there. So when we hear about the sort of monolithic commercial real estate market, it's really lots and lots of markets. And when you hear about sort of the concerns about say, office loans on banks' balance sheets, sort of putting that in context for how much of that total 4.7 trillion we're talking about has always seemed like a really important thing. And I think that was one of the themes that I heard again and again at the CREF convention, is that every property, every loan is different, and the broad brushstrokes don't really apply. In terms of the maturities on the next slide, as was mentioned, we released the year-end numbers from servicers on what's coming due of that 4.7 trillion when. And there's about $930 billion coming due this year. It's about 20% of that total amount of commercial multifamily mortgage debt outstanding. It's 20% of the total. If you look, it's really interesting breaking it down by property type, and then we'll talk about capital source in a second. But you've got relatively smaller share of multifamily loans are coming due this year, and relatively larger shares of office, hotel, and retail. That there are more of those that are shorter term adjustable rate loans. So they're sort of front loaded with more than 20% of those totals coming due this year. Whereas if you look at multifamily industrial, you've got less than 20% coming due. So big differences there by property type.
Jamie.
Victor, you were going to jump in?
Yeah, Jamie, didn't mean to interrupt for too
Please.
long. For this slide before you leave it, just wanted to give you and the research team kudos for presenting a maturity schedule that adds up to the 4.7 trillion of debt outstanding that you mentioned earlier. And so from an analytic and data point of view, that should be internally consistent, but yours, I think, is really the only shop that's charted this out over 2024 to 2033 and beyond. and said, it's an estimate. We understand there are reporting lags and so on and so forth, but this is a great picture in my mind of what we're facing. Thank you.
Thanks, Victor. That's super helpful. And I have to throw all the kudos to the MBA members who are servicers and lenders out there who feed us this information. So we got information on $3.5 trillion of commercial multifamily mortgages that we're able to report out, essentially 100% coverage for everyone except for the banks, because there's 4,600 banks out there, but we got about a third, reporting on about a third of the bank mortgage debt outstanding. So we're able to have a really good sample to gross that up. So thanks for that. Looking at the next slide, then sort of same look, but broken out by capital source, and even more dramatic, I think, in the fact that there's very different maturity schedules for different capital sources, which makes sense. If you look at Fannie, Freddie, FHA, life companies tend to do longer term loans. Those loans, about 3% of GSE and FHA loans are coming due this year, well less than 10% of life company loans. You look at depositories, credit companies like mortgage REITs, debt funds, the CMBS market, particularly the SASB, you've got much greater shares of those loans coming due, particularly the loans that have been done in the last few years that were shorter term. One interesting piece of this is this is when the loan matures. A lot of these loans have built-in extension options, and or the lender and servicer has discretion to extend those loans, make modifications, do whatever is in the best interest of that deal to get the property and the loan from sort of here to where it needs to be. So on the next slide, what you'll see is that meant that a lot of loans that were meant to initially scheduled to mature in 2023 through those built-in extension options or the discretion of lenders and servicers got pushed to 2024. So if you look at our survey last year, at what was set to mature in 2024, there was about 660 billion of loans that were going to mature in 2024. You look at the end of 2023 and how that changed up to 930 billion. So 200 plus billion of loans that were pushed out a year, where the lenders, the servicers, working with the borrowers said, let's work out something that will help us get through some challenges. Borrower brings some additional commitment to the deal, and sort of give that extra time to figure out what the best step is for this property and this loan going forward. So you can see here how those maturities changed from last year's survey to the end of 2023 survey. And I think this is all signs of the market working through things. We'll probably see some of those 2024 loans. Some of those have built-in extension options, or otherwise lenders, servicers will say, working with the borrower, getting that commitment and giving it another year to sort of work through things will be the best deal. So I'd expect that 2025 bar to grow between now and when we do this survey again next year. So this was some of the background information that we presented at the beginning of the conference to sort of prompt conversations, give a little context for a lot of the discussions that we're going to go on there. David, hopefully that helps set the stage a bit.
Yeah, that's great. And we do, before Lonnie and Victor jump in, we've got a couple of questions. One is, can the people get these slides?
Yes, and two ways. One, we can share them. Two is that if you go up to MBA's website, we have a blog there. mba.org/CREFintel, CREFINTEL. And the timing is such that we're actually going to do a chart of the weekend blog post. On that last chart will be posted on Friday. So you can get some of the additional information out of that.
And there was a question about the year of reference for that 929 billion in loans coming due. What's that reference?
Yeah, so that is as of December 31st, 2023. That's what's set to what had contractual maturity dates of 2024, sometime during the year 2024. And again, there might be built-in extension options that could be exercised, lender servicer discretion and other things, but it's set to mature during this year.
And so Jamie, to clarify as well, that 929 for 2024, if I was reading those columns right, it used to be 726, is that right? For last year's edition, which means that the 2023 modifications and or extensions added about 270 or something to 2024. And I guess the reason for my rattling off all those numbers is not to impress you about my ability to read your little columns and get it down to the ones digit. It's more to say that for the industry, about 37% of 2023 maturities ended up being modified or extended in some way and pushed to 2024. Not saying we're extending and pretending from a glass half full perspective. I'm kind of thinking, this maturity wall story has been around every year, but as with our industry, unless there's systemic crisis, it looks like we're going to dismantle that maturity wall loan by loan and brick by brick. We'll see. Whether or not we can continue extending through the next year. And so that I think is going to be the topic that we're going to talk about. Is that fair? Like, it's that like kind of back into some of those numbers?
Yeah, I think that's spot on. If you look at last year, your 700+ billion is right on for what matured in 2023. And to your point, like our estimate is that there was 400+ billion of loan originations last year, which gets you to that same sort of delta of the volume of loans that sort of were coming due. You didn't see that in origination, so it makes sense that those rolled on to 2024 or a future year.
So another question on Victor's point is, so if you went back 2 years, how would that look in comparison, you think?
So 2 years probably would have been not dissimilar from the end of 2022. That's, we can pick which year we want to compare, what was set to mature in 2024 or what was set to mature in 2023. But the 2023 maturities would have probably been on par with what was set to mature in 2022 at the beginning of that year. The originations really slowed down the second half of 2022, going into the fourth quarter there. So the Q4 was lower. You probably had some loans that were extended out at that point, but you didn't have sort of a full year's worth of working through some of that, which was, I think, the case this last year.
And also just from a publication point of view, again, kudos to you guys, Jamie, but I did go back a few years via the MBA's always available PDF archives. And I think for the full maturity schedule, you might have only begun producing this 2-3 years ago, right? You'd produce the survey, it was there from 2020 or 2021, but this full schedule and its updates really only started, this might be the 3rd or 4th edition only, right?
So we started the survey in response to the original wall of maturities concerns back in 2008, 2009. So we started collecting the information there, and we've got the full series going back of non-banks, so life companies, CMBS, GSEs, others. The last 2 years are when we've been able to pull in the banks because, again, we've got that super sample of about 1/3 of the bank debt outstanding. So getting that full picture is just about 2 years.
Lonnie, how does this compare in your world?
Yeah, I think Jamie went through a really great overview. It's nice to see real time, what happened in 23. I think what's interesting here is I'm maybe a little more skeptical of the strength of some of these extensions and modifications relative to their ability to continue to do that. I mean, at some level, it makes sense in the short term if you have a borrower sponsor that's willing to put in capital or fund reserves or do some stuff to extend in the short term. But if interest rates persist at the level that they are, and for office in particular, if occupancies continue to stay where they're at, cap rates are still somewhat of an unknown. Only sales we're seeing right now are forced sales. Starts to beg the question, like, how much longer do these things continue to extend? Coming out of 2008, the extend and pretend narrative worked in the sense that the Fed was aggressively cutting rates. And so if you could make something viable long enough, effectively the interest rates would become positive for the borrower and they could refi. In this example, it's the exact opposite. And so I know we're going to talk a little bit about interest rates and so forth throughout the presentation, but I think there's some benefit, even if the Fed only does a 25 basis point rate cut in the near future, there's a psychological advantage that the market will feel that we've maybe hit peak interest rates, and some of these modifications start to rectify themselves. So it'll be interesting to see. I think 23, for all of the doom and gloom narrative, actually from my perspective turned out to be a pretty productive year, all things considered. And I think there's definitely a sense of optimism heading into 24, even with some pretty stiff headwinds that we're facing right now.
I don't think any forecasts were out there calling for the S&P to grow by 24% in 2023. And to be fair, they did. The equity markets did wait till like November or December before they gave us that holiday surprise, right? And so in hindsight, so much of this can be explained, but it's really hard to figure out what's around the corner.
Jamie, I always view the convention as sort of the kickoff of everybody's programs. So what was the chatter on the floor, and what do you see from a volume standpoint, and who are going to be the players that are going to be providing the debt this year?
Yeah, it's a great question, and I totally agree. I certainly love getting to go to the conference and hear folks' varied views on where things are. And I think you do get a little bit of sort of going into the conference with lots of views and then coming out with sort of people having bounced their ideas off of others and a little bit more down a central chute. But I'd say that this year I heard still lots of varied views coming out of the conference, which is probably the reality. One of the pieces that we heard a lot is that this is a time really not to paint the markets with broad brushstrokes, that what might be happening with one property type versus another can be varied. What might be the perspective of one lender versus another might be varied. The vintages are different, that every deal is in a very unique place. And I think this gets to Lonnie's point that owners, lenders, servicers are all working through things sort of one deal at a time. And some it might make sense to sort of extend with the borrower committing and the lender and servicer committed, and some it might not, and some, if they were done 10 years ago and have had 10 years of appreciation and cash flow increases and were done on a fixed rate mortgage, there's a lot of reasons to see that property sort of blowing right through and refinancing pretty easily. So lots of variety is what I heard. And then I think a watchword I heard, and I'd be interested if Lonnie and Victor sort of heard the same vibe, was sort of opportunity. We do a bingo card to end our session every year of the topics that we expect to be hit on and to be hearing at sessions and in hallways and receptions and other things. And the last 3 years, COVID has been the center square there. And this year it was opportunity. And it's not that people are necessarily diving in, but there was a lot of talk of people sort of looking for where they can be wading into the market to make sure that they don't miss out on the opportunities that are there. There's capital available. There's sort of an expectation that there are going to be good deals to be done. I don't know, Victor, Lonnie, does that match what you heard?
I think there's a certain hope that there will be more activity this year, depending on which measure you use. Jamie, your count of loan originations by volume down 47% in 2023. If you trust MSCI's numbers, RCA's numbers, yes, Jim Costello's a CRE, so I guess we should trust those numbers. Transaction volume down, 43, 44% last year, curiously parallel to each other. Now I think that most prognosticators are hoping for a good 25 to 30% increase. And Lonnie, I'll throw it over to you shortly. thinking conduit plus SASB $40 billion in CMBS of issuance in 2023, fingers crossed, maybe we'll get 25-30% more issuance this year. I think our run rate through January and February, it provides some hope to that. But then there's the whole, that's the necessary condition in my mind, mathematically speaking, is some stability when it comes to rates and cost of financing. And then the sufficient condition will be, okay, then there's that lowering of the bid-ask spread, meaning will we finally get a slew of repricing in different kinds of assets so that sellers will feel like, oh, God, I can't benchmark off 2021 highs anymore. We got to sell now. And or buyers will go and say, oh gosh, well, I guess we really need the gun for it if rates are going to come down soon. And so if there's that meeting of the minds, I do think those would be the necessary and sufficient conditions for more optimism and activity to really manifest this year. Point of uncertainty, there's just a lot of political uncertainty given what's coming up in the US in Q4. But, you know, just to make folks outside the US feel better, it is also a global thing, right? Jamie, I think you heard me mention this. By my count, about 76 countries out of the UN's 195 are holding elections this year. Indonesia just had theirs last week. And so with all that uncertainty, how do we move forward from there? Do we move forward? I think there are opportunities. Then it becomes a matter of executing. And as you said, Jamie, at a time when things are kind of flat, I think global GDP growth will be 2.4, the third year in a row that will slow down. Then the ranges are what matter, right? If everything's going up, then okay, then averages might be a better proxy. Now it's the ends where I think we'll find those opportunities. Back to you guys.
Well,
Alon, I guess I teed you
yeah,
up, put you
yeah,
on the spot for CMB.
yeah, it's great, Victor. Like you speak as like a 5-star restaurant, then I come up sounding like Golden Corral. It's great. You
I
have those
love
numbers.
Golden
I would
bring up
I
Denny's.
would
Let's go Denny's or IHOP, man.
I would agree with Jamie. I think there was a lot of, people talking about opportunities and 24 being opportunistic. I also think one of the central themes was the resiliency of the marketplace. As Victor just mentioned, with a lot of the political unrest, the geopolitical, the macro environment that we're facing here in the US, we haven't seen a huge drop off in sentiment around the CRE landscape. Obviously, volumes and transactions were down, but if you look back coming out of COVID, 2021 kind of set the world on fire. And you look at originations, you look at transaction volume in 21, it was almost an outlier relative to a historical norm. And then 22 through the first 3 quarters was actually on pace with 21 or even higher in some of the lending sources. And when the Fed started taking action, the latter part of 22, you really saw the spigot turn off and things dried out. So I think, for me, the sentiment seems to be that the market hasn't fallen apart. The asset classes have proved to be resilient, and people are really leaning into that local, hyper-local type of narrative where within certain sectors and certain markets, they feel very strongly that there's going to be good opportunities and not just distressed opportunities. There's a lot of markets that still have solid underlying fundamentals, good net in migration, new construction, a lot of positive things where those are growing local economies. And so new development hasn't completely stopped. And I know, it kind of gets brushed under the rug given the cycle of office, but we've delivered about 1.1 million new multifamily units across the US this year. And we've seen a retreat in rent growth. I think you already matrix had that rent growth on average nationally this year was about 1%, which was below the last 5 years, but it's still not net negative. It's still a positive growth market, even with that new supply. So I think opportunistic is actually a fair place for people to have their head. And I think the availability of capital, there's a lot of debt funds that need to place capital. There's a lot of other players in the market that are kind of bumping up on some deadlines. So you may see that bid-ask spread that Victor talked about come in just because some people need to put capital to work.
And to be fair to our friends at the Federal Reserve, I know they raised rates at an historically fast pace. But if you actually chart out what the EU and Canada and the UK did, it actually lines up very close. So, this is a coordinated effort of a lot of central banks to really rein in inflation because of their experience. And it is a tough job. It is a tough job for you to, be responsible for monetary policy in these large advanced economies. With the exception of Japan, which never raised rates, it's still really flat. So to be fair to like the policymakers, I know we're all, oh God, when is the Fed going to lower rates? Is it 4? Is it 2? It's a tough job. I'm glad it's not my job. How about that?
For all three of you on the theme of volatility. So while you were there was a hot CPI print, interest rates shot up. Was there any reaction at all? Any talk about how that might impact their programs or actions or?
Jamie, we were there right the next day, right? So I'll cede the floor to you. Yeah.
I'd say that maybe there were a few more people in some of the receptions that night. After that happened, it reinforced the point that I think both Lonnie and Victor have made, that that volatility has been just as tough as any levels that are out there. That if you look at the 10-year and the way it's been bouncing around, it's really hard to figure out. Is now the time to act? Is next week? Was last week? Unfortunately. And that is without a doubt a challenge. What was mentioned earlier, I think the thought that rates were going to come down, it's still in our forecast. If you look there is an expectation that rates will come down from their current levels. Forecasts are worth the paper they're printed on, but to the degree one is looking at that, it's hard to say why would I go ahead and act now if I don't have to, and maybe things get better in the next 6 months. So I think that's been a key to sort of the challenges of the market is the volatility as well as, again, the levels. Victor, I don't know if you want to challenge me on that or.
No, I think as with anything, there's so much headline risk from successive media announcements in our modern 24/7 cycle. I would love to be a fly in the wall to see what happens to the Fed when they meet this March, because as far as I remember, this inflation number that matters more to them is what's going to be released on Feb 29 next week, not CPI, but PCE. And yet that headline number of CPI, it is correlated. It is very much impacted by shelter inflation. And so we can get pretty technical about it. But I think in the short run, there's a lot of headline risk, and it takes a lot of discipline to have a cool head and go and say, I get it. The 10-year treasury has moved by 70 to 80 bips up and down over the last 3 weeks, right? What does that mean when it literally between 3.8 and 4.3? That is a world of difference, right? For the risk-free rate. And so I think that the market would appreciate a bit more certainty about where that's going. But I also think that everyone's kind of settling into that notion that trending hashtag, not woke up like this, but higher for longer, might actually hold true, right? So if there is no recession, or if a recession is really mild, even if the Fed feels compelled to lower rates, it might not be as much as others think. And higher for longer may well be what we need to budget for. Back to you guys.
Yeah, I would agree. I think the higher for longer narrative is playing itself out. They've been pretty steadfast outside of the initial transitory discussion that we had. And then they started the aggressive rate hiking. The higher for longer has been the narrative. And I think people are having to come to the realization that actually is what's going to play out. And even in 24, if there's a few rate cuts, rates are still going to be significantly higher than they were. And I think, Victor hit on an interesting point. We live in a 24/7 information overload society. So it's interesting if you see some of these announcements, CPI or some other things that maybe used to on their own make people really hesitate or take a deep breath or whatever. Now they're kind of just part of the news cycle for that day or a couple of days. People start to dissect them, talk about the shelter lag and the CPI and why it's not as impactful. And then we're just on to the next topic. And so I think it's of interest, but I feel like people have kind of gotten somewhat immune or numb to those numbers as being like completely directive for them. It's part of the equation, but I don't see people sitting around waiting for CPI print to come out to make like an affirmative decision on what they're going to do with their portfolios per se.
But
Maybe
back to what David
one-
said, right? Like, I think, like you mentioned, David, that commercial real estate is making the headlines, and unfortunately, it's still true that if it bleeds, it leads, right? So
Right.
we just need to be pretty mindful about information flow and how we react. So, but Jamie, you're about to say something. Sorry.
Yeah, just sort of a last point on the interest rates and the Fed in particular. The Fed is using their hammer on the short end of the curve. And it's super important, particularly for adjustable rate borrowing, for short-term borrowing, very influenced by that. I think it's interesting to think about the 10-year Treasury, which drives a lot of the longer-term commercial real estate borrowing, that's based on what you expect to happen over the next decade, right? And that's the economy and inflation and rates over that whole period. And whether the Fed lowers rates 3 or 4 times this year, the impact of that over that 10-year period, probably not as great as what we're giving it credence for. So I think it's worth particularly thinking on the longer term rate impact of all the other things that are going into those rates and what's affecting them. And definitely the Fed is important, but there are a whole lot of other factors at play as well.
Lonnie, let me ask you a question. You wrote today that office values probably haven't hit bottom. And I'll combine that with a question from the audience saying, curious how each of you would define the best case and the worst case scenarios for commercial real estate this year.
Yeah, so I think on the office values not hitting bottom, I mean, we've seen some signs of bottoming out in potentially LA, San Francisco, Chicago, where you've seen a handful of office distress transactions. As an example, San Francisco previous trade in office maybe was $1,000 a square foot. Most recent forced trade, $250. That's pretty sizable right down. And I think that gets you pretty close to where the bottom might be. But as Jamie kind of showed us on the lead in here with the rollover maturities in 23 to 24, we haven't seen those type of transactions at scale. And until we see them, I would say that there's really not a bottom in place at this point. And best case, worst case, like best case is those extensions work themselves out. The property owners are able to get revenues and NOIs to where they need to be to make them viable. They refi into more permanent financing. Longer term, everything works itself out. The value losses were paper losses and no one actually had to realize them. That'd be great. Worst case is the regulator changes their tune. They tell lenders to quit, working with borrowers as much as they have. Some of these assets start getting marked to market. Reserves go up, things get a little bit hairy, and you start seeing some forced sales at scale where, that 40, 50, 60% write down starts becoming more prevalent. So just for some context in the CMBS market, for office properties that matured in 23 that had special servicing and got a new appraisal, depending on year built vintage, the appraisal reductions on those were somewhere between 52 and 60%. So again, it's not a sale, it's a hypothetical value from an appraiser, but it gives you some context of what the real impacts could be in a worst case scenario if those types of forced sales took place across multiple markets, across the office sector in particular. But you're starting to see some cracks in multifamily, Sunbelt stuff that was purchased at the peak, short-term floating rate debt, value add renovation plans that haven't been fully executed or realized. And again, we mentioned earlier, this is not broad brush. Multifamily nationally, I think, is strong, but in some markets, you're going to have some distressed multi stuff that we start to see maybe some activity on the distress sales side in 24, first part of 25 on those deals.
Any other thoughts? Victor?
Jamie?
I think Lonnie's pretty much covered it at this point. I tend to think in terms of best case and worst case scenarios, right? Which I think we've dealt with here. Hopefully the worst case will be more of what felt like 2023. We all kind of survived that, even if volumes drop and deals are postponed till there's a bit more clarity. And then the best case would be a little bit more certainty when it comes to rates, cost of financing, and pricing. And then suddenly we might see that 29% increase in loan originations materialize. Oh, and by the way, for perspective, and I'm kind of ragging on Jamie here, but that 29% forecast for loan origination increase is actually fairly that brings us back to maybe origination levels from, that's 440, 576 billion, maybe 2016, 2017, so from almost 8 years ago, right? And so I do feel like there's some upside there, and there's an opportunity here for us to, really work on greasing the wheels of financing.
Yeah, and I would just build on both of those comments by sort of the best case and the worst case is going to be so particular to an individual property, right? That the best case for one is the worst case for another, and vice versa. That there are some where there's a phenomenal best case out there, right? There are folks building because they see great opportunities, and then there are others where there's sort of, it's hard to find a bid. So that picking the industry out into the subsegments it's really now more than ever in my career. I think that's super important.
So on that topic of risk and create opportunity, Victor, from a buy-side investor's perspective, what are you leaning toward? Debt versus equity plays these days?
So I think this really does hit at the point of just risk return trade-offs and where we think the future will go. I do think that there's a window here that we're looking at where debt instruments can offer, depending on the structure, equity-like returns, right? So you've got some funds out there that are promising returns, levered returns at least, that might be comparable to what you would get from the S&P 500 over a 20-year time period. I'm not sure we've seen that in the last cycle where interest rates just kept on going down, right? And so there's definitely a window, I think, for debt financing if, structured properly and you take the right opportunities and evaluate the risks appropriately. That it very much mirrors, I think, the rise of a lot of private credit funds out there. Jamie, same numbers as you. Take a look at the pandemic years through 2023 for, I guess, your debt funds category. It increased by something like 40% versus the prior 4-year period, where not just the higher interest rates, not just COVID, you see banks and CMBS kind of pulling back. And it's not just driven by this past year. And so I think that there will be different types of lenders hopefully coming to the fore, even as others might feel like the regulatory environment or other things prompt them to pull back. But I think that is a sign of a well-functioning market, right? If there are opportunities out there and it just doesn't work for some types of investors, then other types of investors should come into the fray with a different appetite for risk and rewards. I do think, though, that core funds will probably find it hard to navigate this environment, which probably means that you have a lot of value-add or opportunistic funds that are trying to make a play for it, promising higher yields. And so that is my completely generic assessment of the buy-side investment world. But a lot of the dynamics that Jamie and Lonnie have outlined very much affects stakeholders of different colors and types. Back to you guys.
And I think, Victor, sort of building on that a little bit, the market has gotten so refined at fine-tuning the ways people can choose to put their money to work in commercial real estate, right? From equity and some of the different flavors of equity you were talking about, to debt and the different flavors of debt, the tranching of that debt, whether it's a mezz debt or a B note or other things, and so people can really choose the risk level they want to take on and the return that they're going to get in correspondence to that. So, I think coming into this, the fact that we had that differentiation of the different roles really has made it pretty clear as we're working through this, sort of who's first, who's second, who's third, who's fourth in in any challenges that hit a property. And now you've got the same thing coming out of it, that people can choose sort of whether they want to take something that's a relatively conservative play in the market, or whether they want to go out there a little bit further, whether it be by sort of structure or type of investment or other thing.
There's a question that came in that may be around sort of trying to source opportunities here. So is there an industry source that's tracking workouts and modifications? Extensions at maturity versus extensions that are permitted in the original loan docs?
Right. So if you break the market up into, and thinking about that first slide again, the different parts of the market, there are the sort of most public of the securities market, the CMBS market, maybe CRE CLOs. Lonnie can speak better to this than I can, but where there's just a slew of information, and there are people poring over that information that TREP and others are producing each month, week, day, on what's going on with individual assets and tracking that. Then you get to sort of the more private parts of the market, and you get good aggregate stats on it, but there aren't necessarily sort of that transparency straight down into an asset to let someone find out, on banks or life companies, balance sheets, what might be troubled assets that folks could be looking for. So I think there are other ways of getting to that. So working with industry professionals who are in that market, sort of as brokers, as loan sales advisors and others. But there isn't sort of a website for that, I don't think. Lonnie, I sort of jumped in front of you on some of that.
Yeah, no, you're spot on. I mean, we're written into the reporting structure on the securitized deal, so we get that data monthly, and can see real time with real numbers at the property level exactly what's taking place in terms of extension, modification, what the terms of the extension are, et cetera, et cetera. So we have full transparency there, but it's just that securitized subset of the market, so it's not, encompassing everything. We do also manage a pretty large bank consortium of data that we also have aggregate level information where we can see general trends down to a zip code level, where we can see not identified properties, but just generally what's happening at that level. So, I think as Jamie mentioned, on the securitized stuff, it's pretty straightforward. Outside of that, you're going to have to work with folks in the know and that are in the business, and they'll give you directional perspective on what's taking place. And just for those in attendance today, I mean, if you're not using resources like Twitter and LinkedIn and other things, it's amazing how much information people put out there for no cost that you can effectively get real-time updates from people that are working on transactions and deals. Again, they don't identify the property in every case, but they do give some really good perspective on what's taking place real time.
Another question rolled in from a fellow CRE. What impact might consumer credit debt and bank CRE exposure have on projections?
Victor, do you want to take a first crack at this one?
I'll take a quick stab. I do think that this is consistent with what we mentioned earlier about just greater information out there and how we interpret and act upon it. You can download great data on bank CRE debt from the FDIC and the FFIEC, but it actually just limits you to things like CRE debt over total bank assets. It doesn't quite give you a window into the quality of that commercial real estate debt. And so some of those statistics, if you calculate it on the fly, are scary. I'll admit. It's like some banks have, a lot of banks have 300% CRE debt outstanding over total bank assets or bank equity. But again, I would take a look at those numbers with a bit of a grain of salt and just kick the tires a little bit more to go and say, I would probably be more worried if those bank loan compositions are made up of office properties in San Francisco with an 85% LTV, and maybe less worried if it's mostly industrial properties with 40% LTV, no matter what its relation to bank assets are. And so my thinking is, yes, right now you will hear statements like yes, there's trouble. It does not feel systemic, right? Whether it's consumer credit card debt or I don't know, federal deficit, it's ballooning out of, oh my God, 120% debt to GDP ratio and all that. But if enough of us let it get to our behavior and we start pulling back on capital, and yes, then it will be systemic, wouldn't it? And so I just urge a little bit of mindfulness and caution as we interpret a lot of these numbers. I'm not saying that there isn't risk out there. Yes, there is. But, it very much depends on how the masses of investors end up deciding how to play this. Over to you guys.
Yeah, and I think building on what Victor had to say, you can go to the FDIC website and see for every bank
Yep.
what their holdings of commercial real estate are, what their delinquency rates are, what their charge-offs are, for every bank every quarter. So you can get down to that level and drill into that. And then in addition, the FDIC didn't wake up last March and say, wait, there's commercial real estate at banks. They have been focused on commercial real estate at banks, certainly since the S&L crisis and probably before that, such that it's built heavily into their capital rules. Their CCAR stress test had an extreme scenario with a real hit to commercial real estate values. They are constantly putting out guidance on the appropriate way to work out commercial real estate loans, or as Victor alluded to, or what they expect of banks that have concentrations of commercial real estate loans. So there's been a pretty careful eye on this sector in the banks, the commercial real estate in the banks for decades. And we're seeing it continue. And, again, there are a lot of reasons for folks to be looking at what's going on in commercial real estate. We're having this webinar now. And it all fits within that context, I think.
Yeah, I would just jump in and say the existence of risk doesn't equal disaster. There's increased risk, but there's also increased eyeballs on it, and people are trying to make smart decisions every day to minimize their exposure or to trade out of certain deals or offload portfolios or whatever they can to mitigate those risks. And I don't think at this point that we have something that's systemic, although I think Victor mentioned, if behavioral patterns start to change, if perception becomes reality for some people, then that makes it a different discussion. But I think as we sit here today, the storm clouds are kind of circling around, but it doesn't mean that everyone's going to get soaking wet or there's going to be lightning strikes. I think there's a lot of people, really smart people, working their best to make sure that we avert a crisis. And if you look at it just objectively, as Jamie mentioned, a lot of these properties are good performing properties in really strong markets. And so, yeah, just the math of looking at concentration ratios may paint a scary picture. When you dig a little deeper, kind of just to the narrative of, I think, this discussion today, it's property by property, loan by loan, market by market. There's a lot of really strong assets still in the marketplace that are performing and exceeding expectations. And so I think it's something that is topical and we should continue to discuss it, and I'm sure we will. But I don't think by definition any of those metrics on their own, make it to where we're going to see some catastrophic event across the industry.
Donnie, you started off with a great statement. Was it the existence of risk does not equal a disaster?
Right.
Right. I this reminded me of a somewhat personal note that, I probably was taking a risk when I decided for a bilateral commitment to marry my wife as opposed to keeping my options open. But when I calculate the returns over a 24-year time period, the returns seem pretty worth that risk for me. I don't know what her assessment is though. So
that's a whole other webinar.
Yeah,
That's right.
whole other webinar. Yep.
So we're about 7 minutes left. So we're at a little fork in the road. I got a question from a former colleague from Canada who wanted to understand the market and the upcoming US presidential election. And actually not knowing who our nominees will be. What are the opinions with regards to what will happen to the debt markets
Can I start? Because it's going to be short. And
Yeah.
number one, my employer is Canadian right now. And so just wanted to let our anonymous Canadian question asker know that I know how to pronounce process now, not process. So there's that. What we've been saying is that this is a binary risk, right? We don't know what will happen in November. You can't DCF that. It's more option value pricing, which probably means we'll see. Overall, it probably means maybe we'll get more deals done in the first half of the year to just close that out before the uncertainty starts spiking in Q3, Q4, and then things will settle down. I will share some recent research that shows that SASB CMBS yields have tended to spike the most right before electoral periods. And so take that nugget of so-called wisdom for what it is. High uncertainty, and then it becomes, okay, what do we need to do to move forward? Over to you guys.
Thanks, Victor. So there were some other topics covered at the conference or the convention, right? We talked about AI, property insurance. John, do we have a moment to dwell on those, or
Yes.
anybody want to pick either one of those? And you've already talked about what's the biggest challenge for forecasters, Victor, and how's AI playing into that, and or what are lenders doing with AI these days?
I'll real quick, right? If you take a look at the S&P 500 and its returns over 2023, so much of it was AI driven, particularly the so-called Magnificent Seven. So there is a lot of hype around AI. In my mind, though, in commercial real estate, the applications have tended to be more on the productivity and efficiency side. Oh, this used to be done by humans. Maybe now it can be done by AI, as opposed to the innovation side, which means now we can truly use AI and pattern recognition to come up with an investment alpha that no one else has seen. I have yet to see that. I'm sure there are a bunch of stakeholders working on that, but that has yet to materialize. Jamie, I know we have spoken about AI quite a bit. Please share your insight, because I love that thing about data structure.
Oh, yeah, sure. So someone pointed out to me years ago that a really fascinating thing about thinking about commercial real estate in the big data world is that big data works really well on data sets that are long and narrow. So you have lots and lots and lots of observations, but not necessarily a whole lot of characteristics or variables for each. And what's interesting about commercial real estate is it's relatively short and wide, that that there are so many individual characteristics of each property, of each loan. And at the end of the day, we don't have that many observations. You know, we're not in the millions and millions that you might see in an Amazon setting. So it really makes it interesting to think about where it's easier and most effective to apply some of the big data and some of the AI to commercial real estate. And I think Victor's spot on. There are folks who are finding a lot of really interesting applications in that productivity realm in terms of sort of getting to answers from established data sets, lending guides, et cetera. And it's going to continue to evolve. So I'm going to be fascinated to see what's next.
I just don't think we've seen our CRE industry being willing or ready to allow AI to drive the investment. How many of us here would put up an AI report to investment or credit committee and say, this is exactly where we should go? AI told me this. I'm not sure that the rest of the committee will look at you very kindly if you did that. I don't know. So
just one building on that. I don't know if others look at the AI suggestions in your Outlook response, but at least when I'm responding to my boss, they're like, yes, fabulous idea. Wow, you are so smart. They're basically
That's not unhelpful.
I don't
On
know if
that
that's
note,
really
that's
what
a
you
great
want
way to finish it.
pressing, just reply that.
Yeah, so let me say thank you to David, Victor, Lonnie, and Jamie for your compelling insights in an uncertain market. A couple of takeaways that I have. One, this is a good moment to remember that all real estate and their capital structures happen to be different. And that's a lesson we all got at the very beginning of our careers. We should stick with it and remember it every once in a while. There's no shortage of data and information. We should be mindful when evaluating it. And finally, the existence of risk doesn't equal disaster. Lonnie, I'm going to use that a lot. So thanks to all of you. It's going to be an interesting year. Please join the counselors of real estate on March 7th for our most popular webinar of the year, featuring the Counselors' Esteemed Economic Advisory Council. You may register at cre.org. Until then, on behalf of the Counselors of Real Estate, thank you for attending this section of What's Next for Real Estate and the Life Experience. Have a great day.
Thank you.
Thank you.